This is Robert Kwok. You may know him as Malaysia's #1 billionaire, but many of you may not know that he has made fortune through futures trading. Even up to today, he still actively traded futures. To quote him, I still trade the sugar market for my claret money so that I can afford precious 1989. If you are winning at the sugar casino, why not continue? Hi, I'm Frankie. Welcome back to my fuck show, Frankie Answers Questions. Today, we will talk about futures. What on earth is futures trading? How does it work? Do normal traders and investors like us get access to markets that he is in? And all you need to know about it. Warning, high risk ahead. Question 1. Robert Kwok is a futures trader? According to Robert Kwok's memoir, since he was going to run a sugar refinery, he needed to know how to manage raw sugar costs. He was taking things in and learning how to trade in sugar futures. He went all the way to London and watched how the British firms traded and asked questions about the mechanics. After that, he started experimenting with futures trading by putting in money that won't hurt his pocket even if he loses everything. And that's how he began to get a feel for the market. In 1963, Robert Kwok made a net cash profit of 14 million ringgit, which is equivalent to just under $5 million by just trading sugar futures. If that's not impressive enough, before that, the Kwok brothers' entire capital was just about 5 million ringgit at the very most. You can check out his book if you would like to learn more about his life. It's definitely an inspiring story to read. Anyway, he sold his sugar refinery business to FGV in the year of 2010 for a total cash sum of 1.22 billion ringgit. Question 2. What on earth are futures? A futures contract is an obligation to buy or sell a standardized underlying asset at a later date at an agreed upon price. The contract must have a size in terms of quantity of the asset involved, an expiry date of the contract, and a price. The key word here is obligation, which means to say that whether the price of the underlying asset is in favor of the contract owner or not, the person needs to honor the contract upon the contract expiry date. Question 3. Why do we need futures? The purpose of futures is to fix the price of an underlying asset in future sale, so it makes it easier for a business to estimate the cost of production. For example, given the volatility of sugar prices, nobody knows how much sugar would cost in the future. It could be very different from the price today. This makes it hard for a business to estimate the cost to produce your product since the cost keeps changing day to day. Therefore, if both the buyer and the seller are able to agree on a price that is reasonable in the future, they could lock in the guaranteed sales price by entering into a futures contract. Question 4. How does futures contract works? Let's go back to the example of Robert Kwok when he was running the sugar refinery business. He needed to sell his sugar, and one of the ways was to use futures contract to do it. This way, the company is able to lock in a price it would sell at and then deliver the sugar to the buyer when the future contract expires. Similarly, a FMCG company like Nestle may need sugar for producing Milo. Since Nestle needs to always plan their production ahead of time, they too may use futures contract. This way, they know in advance the price they will pay for sugar, and they are certain that they will be taking delivery of sugar from MSM once the contract expires. That's an example of a strategy called hedging, whereby businesses choose to lock in a price today to reduce market uncertainty between now and the time that sugar is being delivered. Question 5. So how does this lead to futures trading? Normal people like us are not interested in delivering or receiving a lorry load of sugar in front of our doorsteps. But I'm sure you will be interested in capturing a profit on the price movement of sugar. There are many futures traded in the exchange today that are settled in cash instead of taking physical delivery of the underlying asset. Let's use an example of FCPO, which is a CPO futures contract that is most commonly traded on Bursa Malaysia, to illustrate how futures trading works. First of all, nobody is going to sign a contract without knowing what the details are, right? So before we go into the the details, it is very important to understand what contract we are going into. Let's take a look at what's inside a crude palm oil futures contract. Every FCPO contract is made out of 25 metric tons of CPO. Therefore, every 1 ringgit change in FCPO price is going to affect the contract by 25 ringgit. As we mentioned earlier, it is an obligation to deliver the content of the contract when it expires. Therefore, in the context of a FCPO contract, the entire 25 metric ton of CPO is going to be physically delivered to you if you didn't close the position before the contract expires. And you will be required to pay the total value of the contract based on the price that you initially agreed on. Finally, even though the contract is worth 25 metric ton of CPO, the initial margin payment will only be 4,500 ringgit to enter one FCPO contract, which is a big plus point that attracts people to trade futures contract. We will get into that later. Question 6. How is this different from buying CPO outright? In the spot market, to buy 25 metric tons of CPO at say 4,000 ringgit per ton means you are required to pay 100,000 ringgit today. However, under futures trading, brokers like Phillip Futures only require an initial margin payment of 4,500 ringgit. That's the power of leverage. Speaking of leverage, futures trading has the unique feature to maximize the potential return of your investment, because just 4,500 ringgit initial margin payment, you own something that is worth 100,000 ringgit. That gives you a leverage ratio of about 22 to 1, whereby your money is being amplified 22 times. Question 7. How can I profit from futures trading? Let's use back FCPO as an example. Suppose the CPO is trading at 4,000 ringgit per ton today, and you expect India is going to increase the buying for the commodity next month because their inventory is being drawn down rapidly. All things being equal, you know that high demand will push CPO price to go up, and you don't want to miss out on the opportunity to pocket a handsome profit on this piece of information. All you have to do now is to contact your broker, such as Phillip Futures, to deposit a margin requirement of 4,500 ringgit to take a long position on one FCPO contract in hope that your prediction is correct. 1 month later, assuming CPO price indeed shoots up to 5,000 ringgit. Good job. You have just made 1,000 ringgit per metric ton. Given that one FCPO contract consists of 25 metric ton of CPO, your profit is 25,000 ringgit. Your margin balance now will show you that you have a total amount of 29,500 ringgit in your account. Question 8. Is it risky? Oh, hell yes.
You're goddamn right.
In fact, leverage is a double-edged sword. I've been painting a rosy picture of making money from futures contract, but the effect of losing money works in the same manner if the market is against you. Imagine you have a long position of a FCPO contract at 4,000 ringgit and CPO price drops. Well, every dollar tick is worth 25 ringgit. The 4,500 ringgit initial margin could evaporate very quickly.
No. Rude. No.
Question 9. What are the other benefits of futures trading? We are familiar with the fees involved when buying a stock. Commission lah, stamp duty lah, clearing fee lah. None of this applies to futures trading. Apart from commission, of course. If not, brokers like Phillip Futures eat what? Even so, the commission rate is substantially lower than investing in stocks because the fee is charged based on the number of contracts instead of the value of the transaction that you are investing in. Furthermore, you can now bet on short positions. How beautiful it is when you know the market is going down and you could actually act on that instead of just staring at the stock trading platform due to the strict regulated short selling rules. You now have 2 ways to make money instead of 1.
Another one.
Question 10. Should I trade futures? To be honest, futures trading is not for the faint-hearted. But if you think you're up for the game, Remember this, a focus on risk management is what separates professional traders from the retail crowd. According to statistics, if you start losing above 30% of your money, it becomes more and more difficult to make that money back. For new traders, I recommend you not to risk more than 5% of your capital per trade and then scale it up slowly as you gain more experience with your trades. Remember, we want to be Robert Kwok, not Rob Hawk. Anyways, this video just scratched the surface of the application of futures in your investment strategy. There is more to learn in order to become a good futures trader. If you would like to find out more about futures trading and derivatives, check out Phillip Futures. They are pioneers in providing online trading services in Malaysia, offering a wide variety of products including micro e-mini size US products. By the way, they also are running multiple campaigns right now and offer draws with attractive prizes and reduced fees. So, if you would like to learn more about Phillip Futures, we have attached a link in the description for you to learn more. Last but not least, I would like to take this opportunity to say Selamat Hari Merdeka, wishing Malaysia to have a brighter future. That's all we have for today. #FUCK.